Hello, this is Dale. And in this video, I'm going to be talking about my 2-day till expiration credit spread strategy on a trade we did on the SPX weekly. It was a bear call on May 8th, 2024. And I want to talk about managing this. One of the keys to credit spreads is I hear a lot of people saying, yeah, you can win a high percentage, but when you lose, it wipes out everything that you gained. I've been doing this for greater than 4 decades, and I know the importance of managing a trade and limiting the amount of drawdown you might have on a loser. And I think this is the key to having a successful credit spread strategy. Just want to quickly go over the advantages of the vertical credit spreads. They yield monthly income on a consistent basis. They're a high probability of success because it's a high probability that the option we sell is going to expire worthless. So we are sellers. We're selling the premium, and time is money, and because it's a credit spread, the last couple days, the premium is going to have a rapid decay, and that's what we're taking advantage of. The other nice thing about a credit spread is you don't have to constantly watch the market unless maybe it goes against you and you have to manage it, and that's okay. And they're pretty low anxiety trades. In this chart, I'm just showing you the rapid decay in premiums in the last 2 days before expiration. Now remember, with a credit spread, we're selling one out of the money and we're buying one further out of the money. And the interesting part about that is that when you're selling one out of the money, the only value that option has is time. So as you get closer and closer to expiration, that premium evaporates very quickly. And that premium, since we have sold, that premium now is ours. Of course, the bear call, what we had here is a type of option strategy used when you think a decline in price of the underlying asset is expected. It's achieved by selling a call option at a specific strike price, while also buying the same number of calls at a higher strike price for protection. How do I determine the strike price? I usually look at a delta of around 0.1 to 0.2. That takes into account all the intrinsic value. So I think it's just an easy way to determine what strike price to use. This is a graph showing the trade. We got in on May 8th, where we sold a bear call. We sold the 9, which was the next day, the 9 May 52.15, and bought the 9 May 52.25, a 10-point spread, and that gave us a net credit of $1.05. Okay. Now you'll notice that all our indicators were saying it was going to go down, and it surely did. It started out going down. But then this one turned around, and this trade needed to be managed. Okay, we just don't let it go till expiration. And one of the advantages of being a member with Options Infinity is that I send out my trades, and not only do I tell you when the entry is, but I talk to you about when the exit is. And the exit is sometimes more important, especially when the trade goes against you. Well, this particular trade we got out, I forgot to change the date here, I'm sorry. We got out on May 9th. We just let the bear call expire worthless, which means we took all the credit in. That was all our money. So basically, we had $1.05 minus 0 is $1.05 profit, or $105 for one contract. That's 100% profit on the credit. $105 for one contract. Okay. For 10 contracts, that's $1,000, $1,050. For 50 contracts, it's 5,250. And I do have some members that go this way. I suggest you start out small and you learn the strategy and you watch me and you watch how I do it. And you have a couple losing trades. Yes, there will be losers. And you just see how you can execute the trades and you continue to stay with it. I always have to remind you that past performance is no guarantee of future results, but this was an actual trade. Let me talk about how I managed this trade. All right. Um, we got in with a bear call and it was going in our direction and it looked fine. Everything looked fine. So the trade was going in the right direction. And at this point right here, we had made $500 based on 10 contracts. Okay. We had made $500. Then it went against us. It went against us, and by the end of the day, it closed just about where we had got in. It closed just about where we had got in, and we were still up. We were only up $200, but we were up. Okay. The next day it opened. See this dotted line? That was the end of the day. The next day it opened, and then about 10 o'clock it exploded through and made a measured move to the upside. And that's always a good point for me to watch closely because this trade is going against us and it's showing that the momentum is in the up direction now where we wanted it to be going down. So I just started watching it closely, all right, because we've got plenty of distance between with the short strike price and where we are, even though it exploded up here at the opening. And then I was watching. And then we had a nice big drop around noontime, and we were only down $500. Well, now that we're in a losing trade, I'm managing this the best I can, and I'm because we can make on 10 contracts, we can make about $1,000 roughly. I'm always kind of I'm always looking at a visual stop of around $3,000. Okay. So, so when we had this big drop down, we were only down 500. I thought, that's cool. That's cool. I'll just continue watching this because here's the end of the day. Here's the end of the trading day. Well, it came up that, and actually at 5, it made another major move. And at that point in time, we were down close to where I wanted to get out and take a loss. But we were only a half hour from the end of the day. So I just watched it. I watched it and it went down. I said, okay, I'm going to stay with this. Had a strong end of the day, but it closed just below our short strike price, and we gained the whole amount, $1,050. Okay. Unless you can watch this, let me do it for you and let me manage these trades because, like I said, the exit is probably more important than the entry for most of these trades. Now, let me talk about the last 15 trades. Once again, past performance is no guarantee of future results, but these are actual trades. And the amount I'm talking about here is based on 10 contracts per trade. The last 15 trades, we had 14 wins and 1 loss. 14 wins and 1 loss. So let's take a look at this. If we had 14 wins, we won $13,250 based on 10 contracts. Okay. We had 1 loser and we lost about 3 times what we gained when we gained, but we had 14 wins to that 1 loss. So we had made 13,250. We lost 3,250 for a net $10,000 in these last 15 trades. And that's the way you want to do credit spreads. You want to manage them. You want to, if it goes against you, you want to get out. I know when to get out. I know when to stay in, and I can do this for you, or I teach you how to do it yourself. Is it possible for you to become a success allowing me to do all the work for you? Well, I've shown you actual trades, and I've had many trades on here with exceptional return on investment. This strategy is not only for new traders as well as experienced traders, um, and it's for individuals with a small portfolio or large. I release 1 to 2 two-day till expiration credit spread trades per week. Now, this is an average. Last week, because there was very little low volatility and low credit, I didn't have any trades at all. But the average is you're going to get about 1 to 2 trades per week. I've got a greater than 85% win rate. And like I said earlier, I won the last 14 trades in a row, losing 1. I hope you join me. Just go to www.optionsinfinity.com, sign up for a member, and I'd like to see you in the room. Bye-bye.